Good afternoon, everybody, and welcome to ETOA's first ever own webinar from here at ETOA headquarters in central London. So welcome. A couple of housekeeping points before we start today's webinar. Currency chaos, the price of a referendum. You will notice a little video screen with myself and Rob on. You can drag that anywhere you like. You can even minimize it, put it in the corner of your screen to stay away from the slides that we're about to show you. Secondly, during the presentation, feel free to submit questions in the question box that will appear on your screen. And also, on top of that note, if you have any technical problems, at the bottom of your screen, you should see a chat button, and you can ask questions there and explain what may be or may not be working for your webinar viewing. Before we start today, we'd actually like to open with a poll, and it's a very simple question. The question is, do you think that the UK will vote to remain in or leave the EU in June's referendum? And we'll reveal the results of the poll at the end of the presentation. So without further ado, I'd like to introduce our experts here today. He's Rob Affleck, he's a corporate FX dealer from Currency UK. Thank you very much, Rob.
Thank you for that. Welcome all. Thanks very much for joining us today. And a warm thanks to the ETOA for enabling the event. My name's Rob Affleck. I've been a corporate dealer with Currency UK for 4 years now. For the last 15 years, I've worked in finance for the likes of NatWest, JP Morgan, SocGen, HSBC, and UBS. Next one. Today, we'll be looking at the currency risk created by the upcoming EU referendum and how you can protect your business. First, we'll take a brief look at what led the UK to this referendum and the effect of it. And no EU referendum webinar would be complete without taking a look at the havoc the polls are wreaking on currency prices. Following on from that, we'll take a look at what the markets think of the probability of a Brexit. Finally, we'll move on to the really important bit, how you can protect your business and the future of sterling itself. Next one. This is not intended as a political history lesson, but some background is helpful. Back in January 2013, David Cameron made an election promise. Anti-EU sentiment, including Europe's effect on our economy, meant some Conservative supporters were defecting to UKIP. Taking a stand on Europe by promising a referendum, Cameron aimed to win back some lost votership. All of this occurred against the backdrop of a slow recovery from the 2007-2008 global financial crisis, which will have added to the general feeling of discontent. Mario Draghi started 2015 with a massive QE program. There was a Greek crisis and low Eurozone inflation, all of which pushed sterling euro into the 140s frequently. Sterling dollar had been mainly trading within the 150s. The exception to this was when Janet Yellen announced in March that the US rate hikes were likely, causing sterling US dollar to drop 4 cents for about 6 weeks. So starting on the left of the charts, in December, after talking up dropping interest rates, Draghi kept monetary policy the same. The markets interpreted this as Draghi's telling us that the Eurozone isn't in as bad a shape as we previously thought. If euro policy is working, there must be some safe haven value. This triggered a frantic reversal of trades and also triggered a lot of automatic orders, compounding the strengthening of the euro. Investors changed their risk perspective from Eurozone crisis to the next big thing, a potential Brexit. On January the 5th, David Cameron's announcement brought the referendum into the headlines. February 20th saw Cameron's proclamation of a better EU deal for the UK and a date for the referendum, followed swiftly by the first major name, Boris, joining the Leave campaign. March's Turkey-EU refugee deal was positive for the euro, as some perceived it as Turkey being close to EU membership and adding to the Leave campaign's immigration argument. George Osborne quantifying the Treasury view of the cost of Brexit mid-April, and Obama stating the UK would go to the back of the queue for trade negotiations, all reduced perceived risk of Brexit, as surely no one would vote for those outcomes. There's a few differences on the US dollar chart. US interest rates were hiked in December, pushing the dollar higher against all currencies. By January, you can see that the Brexit risk has continued a trend already established. February's referendum date and Boris's Leave support pushed the dollar close to 138. And that's a psychological support level because 138 we haven't seen in the last 30 years.
Next slide.
Polls will affect the perception of referendum outcomes becoming reality. From what we've seen so far, traders will dump sterling if they think that we'll leave Europe. The polls we've seen so far have shown mixed outcomes and therefore have generated sterling volatility. I should add at this point an opinion poll health warning. Polls predicted that the last UK election would result in a hung parliament. It turned out to be a fairly convincing Conservative victory. Polls also predicted that the Scottish independence referendum would be a photo finish. It wasn't, not even close. So in terms of our Brexit vote, this is a straight yes-no. The don't knows will have to pick a side if they want to cast a vote, which of course adds uncertainty in poll results. That said, on the left of the graphs you can see sterling jump on the release of an Ipsos Mori poll on May the 18th, showing a 13-point lead to the Remain camp. Decreased risk of Brexit meant increased appetite for sterling. Now, the importance of this was, this is the third major poll in a row to show Remain's lead increasing. One day before, we saw a YouGov poll also showing such an increase. Now, Ipsos Mori's poll also indicated by including the don't knows likely voting intention, the lead increases to 18 points. And that's what grabs the interest of traders and investors alike. So the polls will feed into the market's view of the likelihood of a particular outcome, literally the percentage chance of us leaving. Of course, there is a lot of other data taken into account too when considering the outcomes. Wouldn't we all like to know what the future holds? Unfortunately, I don't have a crystal ball. But we can take a look at what the market thinks will happen. So the table in front of you shows a range of sterling euro and sterling dollar forecasts for Q2, Q3, Q4 of 2016. The data is taken from Bloomberg and represents the average views of more than 80 contributing banks and financial institutions. There's a fair few opinions in there. So the mean forecast on the left-hand table indicates that sterling euro will likely be between 128 to 135 by year end. However, the high-low range shows a low bound of 119 in Q3 to a high bound of 149 in Q4. So that variance in total is 22.5%. That's quite some difference. So even though the mean year-end forecasts are not far from where sterling euro is currently trading, the market is expecting substantial volatility and uncertainty as a result of the EU referendum. The standout point for euro buyers is that the rate could conceivably reach 119, currently 10% more expensive. And for euro sellers, the rate could hit 149. So that's 13.5% less sterling for your euros. For sterling dollar on the right-hand side, the mean forecast shows prices in the range of 144 to 147 by year end. However, the high-low range shows a low bound of 123, so that's 19% more expensive for dollar buyers, and a high bound of 163, 11% less sterling back for dollar sellers. Of course, the bank's forecasts are relatively static in comparison to the actual market movements, which can change on a whim. I'm sure some of you will have heard of the term pricing in with reference to currencies. This refers to live market movements responding to specific data releases, like a poll, which in the case of Brexit alters the market's expectation of staying or going. As such, before the most recent Ipsos Mori poll, there was a higher chance or expectation of the UK leaving Europe, and consequently, a higher proportion of sterling's expected weakness after the referendum result was priced in. So, given that we have an idea of the possible range of sterling, and we can form a judgment of how much of this is already priced in, we can then apply this to a hedging strategy for you. For simplicity, I'll round up the aforementioned variances to 15%, but please use the actual figures for calculations. What will a plus 15 or minus 15% shift in sterling strength do to your balance sheet or cash flow, and how can you protect that? The fact that we're a deliverable foreign exchange company means that we want to give you a practical approach. For hedging, the best practice is to replicate your cash flow forecast with the worst predicted exchange rate for your business. If you know how bad it could get, you can then protect yourself from the worst case scenario. Now, quantifying the likelihood of Brexit is particularly tricky. There's no official figures or guides. All we can do is follow opinion polls on voting intentions. We could also glance at best guesses, like, for example, odds checkers aggregated bookmakers' odds. And on their Brexit odds, overall, we're seeing that their prices are indicating a 20% chance of a Brexit. IG Index have a binary spread bet on Brexit, literally a yes or no. Are we going to leave or not? Their prices concur. They also show a 20% chance of a Brexit. We might also mention at this point that bookies also offered 5,000 to 1 on Leicester to win the Premier League, and are now adjusting their risk strategies after taking a massive hit. So if your business turnover is highly dependent on international invoices, then a 15% variance is basically 15% of your turnover. And is your profit margin enough to absorb this? In most cases, possibly not. Of course, generally speaking, we would advise that you hedge 100% against all risk. If you're less risk averse, you might wish to hedge less. So if only 50% of your turnover is dependent on sterling, and assuming for argument's sake that there's a 20% chance of Brexit, you may consider hedging 50% of your sterling turnover. You can hedge by approaching an institution such as Currency UK to a range of forward contracts. Some of you may have come across this already. This slide is only intended to explain the concept of securing exchange rates for a future date using a forward contract. In this instance, an order has been made in euros, perhaps for a hotel, but it could be a group of orders due for around the same payment date. Once the order has been raised, the euros can be bought for a date in the future, most usually around the date that you need to pay for the order. In this instance, 2 months later, so after the referendum. Once the contract is secured, your cost for those euros for the settlement or delivery date cannot change. Therefore, the foreign exchange risk is as close to zero as possible. So on this particular order, the referendum will have no effect whatsoever. Currency UK can offer forward contracts for up to 12 months if required. We also offer them for all major currency pairs in both directions, so buying or selling a particular currency. Polls will continue to be released. TV debates are being scheduled hurriedly, and their impact will depend on who's speaking and what they're going to say. Are there going to be new arguments? Are there going to be impactful arguments? Ultimately, any impact will be seen in the poll releases that follow. Also, bear in mind this is a moving target, and there's a lot of other data being released as well, which can only add to the volatility. Market reactions so far have shown us that sterling will suffer if we vote to leave. Conversely, recent sterling strength following a reduction of perceived risk of a Brexit shows that sterling will recover should we vote to stay, but some of that will already have been priced in. The US dollar, as a whole, is generally strengthened by global risk, so a leave vote will likely accelerate the sterling depreciation against the dollar. Forecasters are struggling to quantify how the euro will fare, as there is an awful lot to consider. One major risk might be a geopolitical shock that reignites doubt in the euro as a currency. Another could be risk of contagion, so other EU countries deciding to have a referendum of their own. But these issues alone would be enough for a separate webinar. So how quickly could the currencies move? It depends really on how the referendum results are released. If, like the general election, the results are drip-fed, there will be commentary on the results as they come in, and the traders will be gambling on news as it's released. This will cause extreme volatility. If, like the Scottish referendum, the overall result is announced in a single release, there will be a huge reaction immediately. If any announcement is made before the US market opens, there could be a second surge as the US wakes up and continue to push the currency in the direction it's already headed. Also to consider is if we vote to leave, the notice period to leave the EU is 2 years. And will the government rush to hand in our notice? Until the government acts, there will continue to be uncertainty and therefore continued sterling suppression. So I think now you've heard me talk on for long enough. Would you like to ask any questions?
Fantastic. Okay, thank you very much, Rob. We have one or two questions here. Firstly, in case you're interested, the answers are in for the poll. 70% of you believe that the UK will vote to remain. 6% think they'll vote to leave, and 24% of you are hedging your bets, so to speak, and think it's too close to call. So there we go. Very interested. Rob, the first question I have here is you talked a lot about the effect of polls. Every morning, when you wake up in the morning, someone points out here, you hear both sides of the argument basically almost mudslinging. Do you think, from your point of view, do you think that it's not just the polls, but also the kind of level of the debate that's led to a lot of people thinking they don't really know where things are going? Does that add, do you think, a little bit to the sort of uncertainty around the markets, the kind of nature of the debate?
It does. We have conducted our own poll amongst our clients. And therein lies one of the disclaimers about polls in general. We asked our clients.
Right.
They're all dealing in foreign currency. So therefore, they have a distinct interest one way or the other, and probably the results that we had in may be biased in that direction. Yes, I have heard from a lot of people that a lot of people don't really know what's going to happen. They don't know that there's clear arguments. They're asking for clear facts and figures. But at the same point, whether or not they get those, if they're going to vote, they're going to have to pick a side. Some of those may well turn out to be snap decisions on the day. Some of those will have been formed from the moment in 2013 when there was an idea of the referendum mooted.
Right.
Really, the polls, only if there's a massive change in current direction, I think, will they have too much more impact.
Right.
At the moment, sterling is coming back because the markets think that it's less likely we'll leave Brexit. They also tend to flock in one direction. So
right.
If the lead starts to increase for a Remain vote, then yes, we will see the currencies follow that pattern and sterling appreciate accordingly. I think at this point, bearing in mind that there are multiple polls coming out all the time, people are now starting to look at polls of polls and the overall result, and only if we saw a turnaround in there would it really start to reverse the current trend.
Right. Okay. And so obviously the polls, and that's part of it. But also, do you feel, because I think a lot of people watching today are watching, and certainly in other events that we've held to do with Brexit, is that people say that they feel they just don't quite get enough information. That a lot of figures are put out there. You have in your slides a figure of, I think it's £4,300 a head to be lost to each household, I believe it was, in the UK in the event of Brexit. And today, of course, we hold the figure from another body that says 2,750. I mean, surely these kind of things have knock-ons as well, because there seems to be a lot of figures being thrown around, but every time they get challenged on both sides, I've not heard many people be able to justify exactly where these come from, except for their forecasts. There's a lot of forecasting going on. So
this is true. The figure I used was because it was in the headlines.
Oh, absolutely, it was quoted, yes.
I couldn't possibly back that up or tell you where it come from, apart from George Osborne told it to the national newspapers and it grabbed.
And of course, it had an effect. Yes.
Exactly. So, from my interest, I'd be watching what the market did in reaction to statements. In terms of validity, there's been an awful lot of criticism about people making up statistics. Really, in the political side of things, you're almost free to make up figures to support your case.
Of course.
On the currency and finance side, there's money involved.
Somewhat different.
You have to be slightly more accurate. Let's just put it that way.
Right. Okay. Actually, a question of my own here as well, which is, you talked a little bit about outside influences. So obviously we know statements, for example, made in the United States, even belief that we have that China have looked and said, well, hang on, the trade deal, you'll be back at the queue, was the quote. And we know, we've seen that the idea that on the 24th of June, if we vote out, that suddenly we're no longer in the EU, we know you'll need at least 2 years minimum to sort of renegotiate. Effectively, the EU is a bunch of treaties between various member states. How would you, let's just say for argument's sake, there is a Brexit. How would you imagine those sort of 2 years when all the negotiations going on? Do you think, in a way, because of the uncertainty, we would continue to see fluctuations? I know you said you didn't have a crystal ball, but I'm just curious. People might be wondering, is it going to be a prolongation because of all this negotiation that's going on? Is that the general thing you would say in the market, or is this the sort of thing that would scare the market, I guess?
The briefest possible answer to that is yes. Sterling would suffer as long as our future is uncertain.
Right.
Having said that, there's an awful lot of questions to be answered once we actually get to a vote for Brexit. Namely, David Cameron has told us that he intends to resign our position within the EU. That is not actually written in the Referendum Act. In the process of leaving the EU, we have to hand in our notice, and there follows a 2-year negotiation period. there again, plenty of questions involved there, none of which I'm qualified to answer.
Right.
But having said that, sterling's future being uncertain, we would see continued uncertainty around sterling, and bearing in mind there are less risky currencies to hold.
Mm-hmm.
Why would you hold sterling?
Would you hold sterling? Exactly.
It really is as simple as that. The US is doing particularly well.
Mm-hmm.
There may be talk of them raising interest rates again fairly soon. They might be holding off until the Brexit vote is heard of, and we know the results. That might be a green light for them, and in which case, why not go for the biggest currency in the world that can't go bust? Its fortunes are improving, the interest rates are higher than plenty of places around the world. It seems natural to me that investors would flock to places like the US dollar instead of holding sterling or indeed euro.
Okay. And do you think the opposite of that would be, of course, if we vote to remain in, would you imagine very quickly that sterling would stabilise and perhaps even rally? Again, so let's not forget a currency like the euro, which has its own problems. We're not talking about Brexit and this sort of thing at the moment, because Brexit is the sort of the flavour of the day. So
that is the thing. It's taken centre stage for quite some time now. In the event that we vote to stay, I can envisage all the sterling suppression that we've seen really since December time, so circa 15%, just come flooding back.
Mm-hmm.
How quickly? I couldn't possibly say. What I can say is we know we go to the polls on a Thursday. The results will be released on a Friday. I'm not sure what time, maybe around midday, we'll hear the results. That leaves a short amount of time for the European trading session. They'll all be reacting to that before they close up and go home for the weekend. Mm-hmm. The US market will be on board at roughly that time. They'll be able to continue the trend, and then thereafter into the other currency markets. And then we'll all pick up again on Monday morning and continue. So I can imagine that there will be fairly significant appreciation of sterling. It won't all be in one go, but it will get there pretty soon, within 3 months or so. I think we will have seen 15% value return to sterling.
Okay, so it will bounce back. We have a question here, which asks, what impact could a Trump win potentially have on the US exchange rate? It's going a little bit off piece here. I guess what they're saying there is, of course, Brexit is a major moment, but of course, the broader sort of work that you do, looking after currencies, and obviously the travel industry has to deal with many currencies often at once, and has to think about where they're going to buy their currency, at what time to exchange it, and so forth. Can you imagine something like that having a similar effect on the US currencies, or is it something you really don't have an opinion on?
In all honesty, it probably will have an effect. I know that people will get twitchy about him being in charge. Not everybody is a supporter of Mr. Trump. Mm-hmm. Conversely, or should I say, it isn't intuitive, but if people do take the news badly, US dollar could well appreciate, because in times of great risk, people will flood to the one currency that just cannot go bust.
Right. So actually, the dollar may benefit anyway as the world's reserve currency, so to speak.
As strange as it seems, yes.
Yes, okay. And I guess the same person is asking also, because obviously I mentioned about the likewise renewed concerns about economic situation in the Eurozone in particular, with places like Portugal and Italy, Greece and Spain, and wondering whether what could potentially, a scenario could be we Brexit from the UK here, but then what happens is that uncertainty in the Eurozone then sort of leads, you've answered the dollar, you think the dollar will remain a currency people will go to in times of insecurity, but maybe on the Eurozone side, could you see the UK, even if we Brexit, sterling euro rate sort of shifting, should we say, if in the Eurozone there are then problems? Because some people say that the Brexit could start a little bit of a chain reaction within the rest of the EU as well. Is that a possibility that you're looking towards?
Yes, I mean, in the event that we vote to leave Europe, really this is a fairly big topic. We know that there are other members of the Eurozone who are fairly disgruntled, some of which may not be entirely obvious, but, you know, Italy is mired in debt. Portugal is struggling with their balance sheet. Greece, we can just gloss over. Spain, 25% unemployment. Really, the only people who are streaking ahead are the Germans, and monetary policy doesn't fit them. So it may take a while to sink in. There will be a long negotiation period with the UK. It remains to be seen what will happen to the Eurozone. We don't know that the Danish won't immediately call a snap referendum and rush to the polls. The Dutch have already mentioned that they are unhappy about Turkey potentially joining. Really, it's going to open a can of worms. Politically, it's going to be a big issue. And yes, I feel as bad as we are on our own, the Eurozone could soon find themselves in fairly troubled waters, depending on how the announcements are received, and really how negotiations. You don't know that there may not be a wide-scale renegotiation within Eurozone countries themselves, and a renegotiation of the whole way it works. It could happen,
and that could be also spurred equally by a vote to remain, because some people are suggesting that if the UK remains, this might be a little bit, or has been a bit of a wake-up call in Europe, as seen by the amount of coverage that there are in European newspapers and on the television across the continent. It's not simply the UK on its own just deciding to stay or leave, but also people are watching quite keenly. And I think this might be one of the reasons why as well, is that some people see it as a spur, potentially, a more positive thing, should we say, to say, okay, the UK has decided to remain, but this tells us something about the way that the EU is set up at the moment, about certain aspects, shall we say, of the zone. Do you think that's a possibility?
Well, personally, I feel that the idea of the referendum and the Brexit and the headlines it's caused has effectively caused an avalanche. I think there are now forces at work that are too strong to stop. Plenty of people are paying attention to this in other Eurozone countries. We've even got the interest of people outside the Eurozone. There's an awful lot of people looking at this, and I know from a while back, the Danish were saying that they would be watching very keenly to find out what we decided, and may not be that far behind on their own particular referendum. It's not for me to say, but I probably think maybe they're waiting for someone else to set the precedent before they do it themselves.
Gotcha. Yeah.
They might have more of a bargaining stance if we left, and then they were the next ones to step up, whereas if they did it first, maybe they wouldn't have made quite the splash that we had. But again, most of this is political.
Yes, of course, which unfortunately affects, obviously, the currency markets. But just to answer the question of someone here asked, what are the Eurozone pigs? It's actually an acronym for Portugal, Italy, Greece, and Spain, just to make that clear. It's not the ones flying past in the background. So another question then, the one thing that came out of one of your last slides there, which obviously might be one of the points you're making today from a professional point of view, is it sounds like even if we remain, if the UK remains, that there might be an argument anyway, what you were talking about, which is looking obviously at your longer term, medium and longer term foreign exchange risk, that we could be going through a couple of years of turbulence on the continent, and it would be worth looking anyway into that very useful graph that you showed before with forward thinking. So
for the purposes of brevity, we really wanted to explain in one direction to show the way that it all works. Obviously, not everybody is denominated in sterling. If you are euro or dollar, then you will have the opposite effect. And in which case, if you are selling euros, then it now looks, according to polls and various other sources, that we're 80% likely to stay in Europe. If that's the case, now might be a time to offload those euros.
Right, exactly. Because you think maybe the risk will go towards the euro. The sterling will suddenly become good old sterling again, and the euro will become the currency that's put under pressure. Very interesting indeed. Okay, fantastic. Well, I believe that's everything for today. Any more questions come through? No, thank you very much. It just leaves me to thank you very much, to thank Rob very much for coming along for this inaugural ETOA webinar here direct from our offices. And just to flag up that we will be holding another webinar shortly beginning of June, we'll be looking at the effect of Brexit on the long-haul visitor market, in this case China, and also discussing a little bit more in depth the Chinese market for Europe. So in the meantime, thank you very much for your attention today, and we look forward to seeing you in future webinars. Thank you. Goodbye.
Thanks.